the closing bell on Wall Street, and now it is market domination overtime. Jared Blickery going to be along in a moment to give us some details from today's session. I'm going to start with where the major averages ended the day down in a word. We've got the Dow off by 716 points, off by 1.7%. The S&P 500 finishing near the lows of the session as well, off by nearly 2%. And the NASDAQ leading declines as it has been throughout the session. Large cap tech really selling off, down 2.7%. As we've been talking about, sort of the 1-2 punch here of PCE, that is the Fed's preferred measure of inflation, coming out this morning hotter than had been expected here. And so that raising some concerns of inflation maybe not decelerating at the same time that tariffs are coming, and the effect of tariffs going to be more evident in these inflation figures perhaps going forward. So you have that, and then tariffs are sort of the other thing here that people are trying to weigh. We got the announcement of auto tariffs. They're supposed to go into effect next week, as well as the announcement of yet more tariffs. So the market's sort of bracing itself here going into the weekend. Jared's got a closer look at today's action. Hey, Jared.
Thank you, Julie. I'm going to put the S&P 500 year to date, just quickly show the technicals. Not looking good. This is a big red down candle that we're seeing there. And critically, we sold off from the 200-day moving average. That's that blue line here this week. And I don't have a lot of time, so I'm not going to dwell. But suffice to say, volatility is inching back up. We got the VIX at 21.74, so over 20 once again. And then we can also take a look at the 10-year T-note yield, which had its biggest drop since the middle of January. That was just before the inauguration. And there's that candle right there. So definitely a risk-off move today. Some concerning things. Only utilities in the green for the day. And for the week, only staples in the green. Tech down 3.6%. We can also do month today. We only got one more day left. Only energy in the green. And we're seeing some serious losses in some of the mega cap sectors that I'm highlighting. 6 to 9% off. But let's go to the NASDAQ actually and see what happened today. A lot of dark red on your screen. Microsoft down 3%. Amazon, Alphabet, Meta down more than 4%. So is Netflix and Palantir. And just looking at the 5-day totals gets a little bit worse. So not a lot of positive. There is some green in some places. Low volatility for the week is not a great look. I guess I'll leave this on the energy sector. Let's see if we can get some green up here. And we are seeing a lot of green for the week in energy. ExxonMobil up 2%. Josh?
Thank you, Jared. The sell-off on Wall Street gaining steam into the close with just one trading day left to go in March. The S&P 500 on track for its worst monthly performance since September 2022. Joining us now, Steve Sosnick, Interactive Brokers Chief Strategist. Steve, always great to see you on set.
Great to see you too.
So help us make sense of today's action. What do you make of what you saw in the market? We had the economic data this morning suggesting inflation maybe looking a little sticky here, right? I've got next week with April 2nd, right? This is when we expect the White House to announce these new reciprocal tariffs. Yep. Seems like no one wants to get ahead of that. But what do you make of what you saw?
Well, today, it's interesting because in the pre-market, it looked like they weren't really set to sell off. Even when the PCE deflator came out, which was a little high on a month-over-month basis, 0.4 over 0.3, pointing in the wrong direction, it didn't really sell off. It wasn't until the Michigan numbers came out, which was yet another, they come out every 2 weeks, so yet another 2-week period of sentiment getting worse. And in this case, the sentiment wasn't so much the problem, it was more inflationary expectations were the problem. And I think just ahead of a long weekend, ahead of the April 2nd tariff days, just no one wanted to go home long. And to me, the real tell that it was about risk off rather than inflation fears was what Jared just mentioned about bond yields being way lower. You don't get a 10 basis point move lower in the 10-year if you're worried about inflation. You're worried either about a lousy economy, in which case that will sort of in some ways take care of inflation, or just a get me out trade, flight to safety type of trade.
We've been talking a lot about next week, and there seems to be a lot of hopes on the part of investors that we will get certainty. Are we going to get certainty? And if we don't, has the market priced in what's going to happen next week?
I think the market really hasn't. I was out last night with just some people in various different industries, and they were saying, some of the manufacturers just they're paralyzed. They don't know what to do because they don't know how much the cost of goods are going to be. If we're making trading decisions, we can move pretty quickly. If you're making investment decisions, you move a little slower. If you're making corporate type of investment decisions, plant and equipment, you move really slowly because it's going to take you 6 months to a couple of years to even implement those things. And so they're really sort of frozen because of a lack of clarity. So yeah, I think maybe just some clarity would be helpful. We saw yesterday the reaction to the auto tariffs wasn't so bad because there was a little bit of clarity, but even now, nobody's really sure. I was just, back and forth emailing with a friend of mine who's a smart guy in this business, and he really believes that this is all a negotiating ploy and that things won't be as bad as they seem. I hope he's right. I don't see the evidence of that.
I guess, Steve, you're an investor, though, and you're trying to navigate this. And if one big concern is the tariffs, and every day we're just going to follow the bouncing ball of these tariff headlines, what are you actually supposed to do as an investor? Like, are you supposed to somehow you just buckle up and accept that drama and that volatility? Should you try to kind of look through those headlines to the other side?
It depends somewhat on your risk tolerance and your time frame. So, if you've got to put your kids through college, if you've got to write a college tuition check later this year, you might want to pull in your horns a little bit because we don't know that. If you're planning to retire shortly, you may not want to be exposed to the volatility. If you're young and you're in your 20s, early 30s, over the long period of time, these are just blips. So you do have to really think about that in those terms. Also, ask yourself very clearly, on a day like today, where a lot of stocks got clobbered, where the market as a whole got clobbered, did you sort of take it in stride, or did you kind of get a little knot in your stomach? If the latter, that's a sign that maybe you want to be lightening up a little bit. Maybe you want to be moving, Jared mentioned low volatility stocks. Maybe you just want to raise cash. Maybe you want to move to fixed income a little bit, just so you can sleep a little better. Because I think what happened was a lot of people really people started to embrace risk. Very, in a good way. Risk works wonderfully when it's going up, and it works terribly when it's going down. And, sort of 2024, early 2025, people were risk on as much as they could be because the more risk you took, the better you did. And I think that's unwinding. The other thing to keep in mind is, we're still really not, we're down from our highs, but we haven't given back the last 2 years. So,
you're down about 8% from your all-time high, roughly, in the SPX.
Exactly. Yeah. So, an 8 to 10% drawdown, these happen. The question, of course, becomes, it's true fact, the vast majority of the corrections do not become bear markets. Unfortunately, true fact, all bear markets start as corrections. Right. So that's sort of the situation you're in, and that's why you really need to do that gut check.
Well, and I think that we talked to Henrietta Treyes of Veda Partners earlier, who's more of a policy analyst, and she said, there's the question surrounding next week's events of whether it's the uncertainty that is more harmful or the actual tariff news that will be more harmful. And I guess we don't know the answer to that yet. And she said a lot of people she surveyed had said it's the uncertainty. As a longtime market participant, is it better to have the news even if the news is really bad?
In some ways, yeah, it's like rip the Band-Aid off because you know what? Like I was saying about the manufacturers who don't know how to invest. I think in some ways it's basically just tell me what the roadmap will be, and I will follow it. One of the things that it's been a fool's errand to bet against corporate managements in the long run. Most corporate managements are really good at figuring this stuff out, and so I think if they know the path that they need to navigate, many of the better managements will figure this out in one way, shape, or form. It might, that may mean that they're not making as much money as they were. It might mean that they've got to do cutbacks, whatever else. But they can navigate through it. Right now, you're flying blind, and I think that's really difficult for anybody, no matter what your role is, whether investing on behalf of yourself, a portfolio, or a large corporation.
Steve, we had Ryan Dietrich on the show this week, and Ryan brought up one variable I just want your take on. Ryan was talking about sentiment, and he really emphasized how, in his words, over-the-top negative sentiment right now. And he sees this as this possible, obviously, bullish, contrarian indicator. I'm just curious how you see that dynamic.
I respect Ryan and his work. I also respect Henrietta's work. So you mentioned two people whose work I respect. Ryan is right to, yes, that if things get clarified very quickly, if the friend I was emailing is correct and says, the tariffs are just negotiating ploy, the worst, we're not going to get the worst of them, yeah, that can give you a really big snapback rally because sentiment is so bad. But it's not just investor sentiment that's so bad, and this is the part that I think makes it a little bit different. He's correct. Investor sentiment is in the toilet. I have no better way of phrasing that. But also, on the other hand, consumer sentiment stinks. It's not quite at global financial crisis levels, but it's kind of approaching COVID crisis levels. And one of the things that I put out recently was, one of the times that it was this low, let's say before it's actually sank further, it was around where it was, let's say October, November 22, which turned out to be a fabulous time to invest. But I think right now, I just get this vibe that unless we really get things sort of A, clarified meaningfully, and B, get some reaction that it's not as bad as it seems. The problem with sentiment is even if it's rock bottom, it can bounce around on there for a while, which is kind of what we saw today. Yesterday felt like sentiment was sort of keeping us from really selling off. Today that didn't help.
Right. Oh, Steve. On that cheery note,
yeah, sorry.
I hope you have a great weekend and you're doing something fun. Thanks for coming in.
Thanks,
it's always
Julie.
good to see you. Stick around. We got more market domination overtime still to come. Consumer sentiment continues to decline, falling to the lowest level since November 2022. The downward trend does not appear to have relief in sight. The outlook on President Trump's economy doesn't seem to be improving. Here with more, Yahoo Finance's senior columnist Rick Newman. Rick, we were calling it, when it was the Biden economy, the vibe session, where the data was good and people didn't feel good about it. What should we call this one?
I think consumers might be onto something here. I think, unlike the Biden administration, the economy might be following or trailing consumer sentiment here. I'm going to have to come up with a catchy phrase for that, Julia. That'll be my assignment for next week. But a difference between the vibe session and today is this. During, let's say in 2022, fall of 22, which is the last time consumer sentiment was as low as it was, we knew then that inflation was the main thing that was bumming people out, but inflation was improving while at the same time employment was holding up, growth was holding up, and that continued for the next 2 years. Unfortunately for Biden, voters never gave Biden credit for that, but the economy was better than people thought it was. Now, the situation that we're in is the so-called hard data is still pretty much holding up, but a lot of forecasters think that's not going to be the case. For one straightforward reason, that Trump's tariffs are really going to start to damage the economy as they go into effect. So consumers are basically saying things stink. They're very worried about prices going up in the future. They think the job market is getting weaker. And this time around, economists are saying, yeah, that could be the case. We're not seeing it yet in the hard data, but the hard data has a lag. And we just saw, for example, a little tick up in inflation in February. That does not reflect the tariffs that weren't really in effect yet, but it could mean that producers are anticipating the tariffs and they're trying to raise prices ahead of time. And we're most likely just going to see more of that. I mean, one example is cars. Car prices are going to start to go up very soon as long as those 25% import tariffs stay in place. So it could be this time around that consumers are in a better position to predict a downturn in the hard data, which is looking more and more likely.
What do you think we hear next week, Rick, April 2nd? That's when, of course, the White House expected to announce these new reciprocal tariffs. What do you think we're going to hear?
Well, the market expectation a month ago was that, as you guys have been discussing, Trump was going to threaten these severe tariffs but end up pulling back. It does not look like that's the case. I mean, Trump has kind of telegraphed that the so-called reciprocal tariffs maybe will be more lenient than we expect, but that only comes after we got these auto tariffs that were far more severe than anybody expected. So I'm wondering when the markets are finally going to give up on the so-called Trump put, when markets are finally going to say he really means it. He doesn't care if he causes a stock market correction or even a bear market, because he's a hard believer in that tariffs for some reason are the right thing to do. So I do not expect we're going to get a big relief rally here because it hasn't been happening. I mean, investors who have been expecting Trump to back away from tariffs had not been getting it. And I'm not sure there's any reason to think they will.
Tariff man's going to tariff, Rick. Thank you so
Yes.
much. Have a great weekend.
Hi, guys.
Well, President Trump's policies raising several caution flags, sending investor confidence on a roller coaster ride, mostly lower. Yet, according to our next guest, changes in Wall Street also highlight that Trump risk, but also expose other cracks in the market for retirement portfolios. Puck founding partner William Cohen joining us now to discuss. Bill, it's good to see you. This op-ed in the Times caught our eye because you talk about not just the damage that we're seeing President Trump's policies do to the market, but also sort of the backdrop of what has been a boom in passive investing. Why does that made markets sort of more vulnerable here?
Well, Julie, since the 2008 financial crisis, the Fed, regulators, Dodd-Frank has sort of mandated a complete change in the structure of the financial markets. Once upon a time, we would rely on stock pickers, people like Peter Lynch at Magellan, at Fidelity's Magellan Fund, who charged fees and made money based on the stocks in the portfolio going up. And nowadays, most investors are not interested in that anymore. They'd rather just put it in index funds that, like the S&P 500, that are sort of much more automated, computerized. The fees are much lower, and they basically pick a bunch of stocks and stick with them for a long time. And they change them once in a while, but not like a real stock picker would. And so, these index funds tend to chase stocks on the way up as they're going, like the Magnificent Seven. And so when the Magnificent Seven start cracking, that begins to influence the direction of the markets in an exacerbated way. And I think that's what you're seeing now. So, yes, there are still people who pick stocks, and there's still people who choose people to pick stocks for them. But most people now just invest in these lower price index funds. And those, as I said, those stocks don't change very often in those baskets. And then you've got like 10 or 20% of the market are, market makers who are trading in these stocks, in day in and day out. Citadel Securities, Point72, Millennium, places like that are just, moving the markets and exacerbating the trading in and out. So the combination of the two makes sort of a passive investor who's expecting, not to pay much, who's liked the ride on the way up, is now going to have to experience it on the way down.
You mentioned the Magnificent Seven there, Bill. What's interesting is one trend we've kind of noticed here is you have these strategists and they're coming out one after the other and they're cutting their targets, Bill. But one interesting thing is how many of them are still sticking with that Magnificent Seven. I mean, you saw it even this week, Barclays, right? They joined in, they cut their target for the year, but they told their clients, listen, I mean, you stick with those big tech names because they talked about what they see as solid earnings growth and, hey, valuations, they don't look as stretched here. So it seems like those big names you're mentioning still in favor.
Well, look, I mean, there are 7 of them. And so, a lot of the 7 actually are not that crazily priced for the revenue and earnings that they're generating. The big one that makes people crazy and has made people crazy for years, of course, is Tesla, which, trades at, more than 100 times earnings. Anytime a stock trades at that level, you're basically asking for it. You're asking for huge volatility. You're asking for a correction. And people, of course, have lost a lot of money believing that Tesla was overvalued because it's become more of a meme stock. But, between Elon Musk becoming Mr. Doge and going into the government and hanging out in the Oval Office and taking his eye off the ball of Tesla, people are the sentiment seems like it's beginning to change. So if you're in an index fund, which probably has Tesla in it because, it was a great ride on the way up. Now, as it's going down, it's lost, 10 or 15% since the beginning of the year. You're going to experience it on the way down now. And that's just, the way it is. And but the other stocks in the Magnificent Seven, Apple or Microsoft or Google or Alphabet, they're more reasonably priced. They're still expensive compared to auto stocks. but they're not going to be as volatile as the big kahuna in the Magnificent Seven, Tesla.
Right. And, I don't think anyone's chasing after auto stocks at this particular moment, Bill. Bill, I always like to talk to you also because you are well connected. You talk to a lot of decision makers on Wall Street and beyond. And I'm really curious what they're telling you right now, what you're hearing from them in terms of sentiment at a time when sentiment really seems to have shifted 180 from where it was after the election.
Well, Julie, as your previous guests have said, investors, CEOs just would like to know what's going to happen here. The chaos man in the White House who thrives on chaos on a daily basis, that's doing nothing for CEOs and investor confidence. You cannot plan. The irony is, he thinks these tariffs are going to somehow return manufacturing to the industrial sector in the United States. That's not going to happen if CEOs cannot nail down sort of what's going to be happening next. This uncertainty is driving CEOs nuts. And, people have said to me, look, if you're going to have, $2 trillion worth of tariffs, just let us know. If it's going to be $1.5 trillion, let us know. Let us know what it is instead of one day it's on, one day it's off. The market goes up, the market goes down based on whether or not the chaos agent is decided he wants to have tariffs or not. And CEOs cannot run their business like that, and they're completely fed up by this. And and then to say nothing of what the attacks that he's making on Wall Street law firms as retribution, that's got people nuts too, Julie.
Bill, always great to see you and have you on the show. Have a great weekend.
Thank you, guys.
Time now for what to watch next week. Starting off on the tariff front, President Trump's so-called Liberation Day is coming up on Wednesday. The administration planned to implement reciprocal tariffs targeting countries with which the U.S. has a trade imbalance. Trump also announcing this week that he is placing 25% tariffs on auto imports that will take effect on Thursday.
And we also will get news on the labor force. March's full jobs report is coming out on Friday. Economists forecast 135,000 non-farm payrolls were added. That's less than February's number, while the unemployment rate and hourly wage growth could hold steady at 4.1% and 0.3% respectively on a month-over-month basis.
And taking a look at the Fed, we're going to be getting a big batch of Fed commentary throughout the week. That includes Fed Chair Jerome Powell on Friday morning. This is coming after comments from Boston Fed President Susan Collins yesterday. Collins saying that the Trump administration's tariffs will drive up U.S. inflation, but it's unclear how persistent that upward pressure will be.
And finally, some more companies reporting earnings next week, including RH, Conagra, and Guess. RH is announcing results for its fourth quarter and fiscal year 2024 after the markets close. Analysts expect the company's sales growth will pick up, driven by strong demand for the brand and positive signs from competitor Williams-Sonoma, which also reported better furniture sales. That'll do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. They've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.